So yesterday we started Ifrs 16 on leasing, and we were able to define the various concepts in the standard. We moved on to talk about all the terms that we are supposed to learn under the standard, talking about inception of the lease. We also try to look at several examples, how to test if an agreement is a lease agreement or not. We did some computation on short-term lease and lease of petty items that are usually written up in the statement of profit or loss for the period. And we moved on to choose an example of a long-term lease, because where we stopped yesterday. This is how right of use asset is computed when we try to compute it, and we also took an example. It was on this example yesterday that we stopped, and this example we were working. Let me share the screen of the worksheet. We're working on something on the example yesterday before I stopped. So this was what we were trying to do yesterday. We tried to look at the amortization table, how that we amortize the lease liability over the life of the lease, and we prepared the statement of profit or loss. So what I just need to prepare this morning is the statement of financial position in respect of the lease, so as for us to know how that is treated also. So we'll be doing statement of financial position here now, which will help us to understand what should be presented in the balance sheet as far as the lease arrangement is concerned. So let me quickly complete that yesterday's task here. I'll put statement of financial position here. Statement of financial position. Statement of financial position, and what we shall be doing there is to complete what we actually started yesterday. We were not here yesterday, but at least. Good morning, Mr. David, you are welcome. Good morning, Mrs. Ogunleye, you are also welcome. So the thing we were working on yesterday is what I actually want to complete now, so that we can move on to something new. So yesterday we tried to look at this lease. The question is up here. We see how this payment every year is done over the years in this column, and how the interest is computed. This is what we call the amortization table. We will see more of it when we get to IFRS 9, financial instruments, how this table is actually displayed. I'll be doing more example on the table today as well. So when the lease, the agreement was reached at the commencement of the lease, the double entry is that we debit the lease asset with the amount of the present value of the liability, which is actually what has been given us, present value of the lease payment, and credit the liability. This one does not have additional information relating to expense incurred in respect of the lease. So we did this yesterday. And we said what will go to the statement of profit or loss alone will be the depreciation charges on the lease underlying asset, the right of use asset, and the finance cost, which is the expense incurred every year, which is the interest rate, interest incurred every year on the lease, and this is going to be ours. So under the statement of financial position, what we shall be having is the right of use asset at its carried amount, and then the lease liability over the life of the lease. So first, let me have what we call, okay, let me move this a little bit here so so that we have a column for description. So we're going to be having non-current asset here. Non-current assets. And under the non-current asset, we are going to be having the right of use asset, which is what we have here. Right of use asset. So at the end of that year 20x2, the right of use asset will be depreciated by the depreciation. So it's going to be the cost minus the depreciation. That's going to be the value here. Don't forget the value. We use cost model for right of use asset, and it's going to be what? Cost minus less accumulated depreciation. So this is the value that we recognize at the beginning of the year minus the depreciation for that year. And so we are going to have a carried amount. And so once we have that, I can quickly log this because I'm using Excel, and then so I can drag this down like this. Okay, sorry, it's not done that way. So subsequently, this is going to be what? The cost less, or let me put everything in the table here so that if we have it, you see exactly how I'm arriving at the figure. So the cost and then accumulated depreciation. So let me have the cost here, which is what we already have in this place. Costs is going to be the same thing over the years. It remains at cost, but the accumulated depreciation will be changing. This is it in the year 1, and then in year 2 becomes this and this, and this, and in year 3 becomes this and this, and this plus this plus this in year 3, and in year 4 we have becomes this, and this. So that's the value, and so we can have our carrying amount like this, and it is spread over the life of the asset. At the end of the life of the asset, don't forget the question says that the asset has 5 useful lives. So that's why we depreciated over 5 years. But what we have here is 4 years depreciation from 20x to 20x5. So the carrying amount of the asset at the end of its life is going to be 1.140. That is 1,140,000. That's going to be the carrying amount at the end of the life of the asset. That's going to be the residual value. Then we have what we call current liability. Let me have it here. Current liabilities, and then we have non-current liabilities. Non-current liabilities. Non-current liabilities. So if we have those here, current liabilities, non-current liabilities, we need to know how to spread the lease liability, both to divide it to current and the non-current element of the lease liability. Now this is the table for lease liability. You can see it. This is the table. This is amortization table. It's where we dealt with issue of liability. The issue of asset was dealt with here, and we're able to compute our depreciation. I think I did that computation here, and we're able to put in depreciation inside the box here. And the finance cost from the liability amortization table, we also put it here. So we want to talk about lease liability at the end of, so I'm going to say lease liability. So for lease liability, The current element will be the amount payable in a year's time, the amount that the company has to pay in 1 year's time. And the other part of it is going to be what? Non-current liability. So this is 20x2. This is the opening balance. This is how much the company paid, and the balance remains this. How much is the company going to recognize as a liability in respect of this lease in a year time? There are two elements here. The amount paid on the liability inside this 2 million, the amount paid on the liability, and the interest is what amounts to 2 million. So to recognize what we are going to be seeing as lease liability now is going to be the 2 million, that is this 2 million less the interest that is paid on the 2 million on the lease. That's going to be the current liability, the amount payable in a year's time. You can see it. Okay, I need to do something here. It should be coming. It should be this. Changing the formula inside. So this is the current liability, and the non-current liability, which is lease liability. The non-current liability will be amount payable more than 1 year time, which is the closing balance of the lease liability at the end of year 2. So the addition of the two will give us the value of the lease liability at the end of year 1, which is this amount that we have here. Can you see how I arrive at it? Please watch what I'm doing very closely. Watch what I'm doing very closely. Look at it. Current, because why are we splitting into current and non-current element? Anytime a company has a liability and the liability is extending beyond 1 year time, and the liability is redeemable every year, then dischargeable every year, as you say, then there is a current element of the liability and the non-current element of the liability. The current element of the liabilities is the amount payable in 1 year time, and the non-current element of the liability is the amount payable beyond 1 year time. So if you look at it here, this is the closing balance of this lease liability at the end of year 1. And if you check in the balance sheet that we're just preparing now, it agrees with the closing balance. The difference is this interest that is paid. This money that is paid every year is supposed to be the liability, but an element of this money is the interest. It was when we added the interest to the closing balance that the liability we discharge in 1 year time reduces from 2 million naira to this. So this is the current liability, this is the non-current liability. For year 2, we are going to have the same experience. The amount payable in year 3, that is, this amount payable in year 3 less any interest on that amount is the current liability for year 2. This part is very, very important for you to know how to compute it. And the non-current element in year 2 will be the closing balance for year 3. So that when you add the two together again, you are going to be having the closing balance for year 2 of the lease liability, which is what? 3238, which is what we have here. Don't forget, this is 20x3. Closing balance of the liability is 3238, which is what we have here as the closing balance 20x3. You see how I arrived at it. It's very, very important, and this part is very, very sensitive. We need to be paying attention to it. Then we have the current liability in year 20x4 is the amount payable in 20x5. The current liability is the amount payable in 20x5 less the interest element on that amount we are going to pay, and then we arrive at it. This is the current liability, and the non-current liability as at the end of year 3 is what? Is 0. Is 0. The non-current liabiliity is 0 because there is no liability beyond 1 year at the end of year 3, because all liability in year 3 is dischargeable in year 3, which is 20x4, is dischargeable in 20x5. So that the total liability in 20x4 will be the equivalent of the closing liability for 20x4. Can you see? Then what we just have at the end of 20x4 is that our current liability is 0 and our non-current liability is 0. And so we have our balances, we arrive at the closing balances of 0. This is how you prepare your balance sheet as far as this lease arrangement is concerned. Let me put it in a box there so that you understand exactly what we have done when you are reviewing it. So when you are doing your balance sheet, the lease liability will be split to both current and non-current liabilities. And the current element is the amount of money you want to pay in 1 year time, less any interest element on that money. Then the closing balance of non-current liability is the amount that is payable at the end of the year, the following year. Because if this is current, then the other one will be non-current because it's beyond 1 year. Eventually, when you add it up, you'll be having the same information you have as the closing balance in your amortization table, as the closing balance in your balance sheet. I hope you understand everything I've explained in that regard. So we'll be moving on to more examples today because we need to know. Let me move this sheet, this example up, because we have more space up there. So we have more space up there. Oh, sorry. Doesn't agree. Okay, let's leave it there. We use the space for something else. So you can see statement of financial position. This is it. Statement of profit or loss. This is this. The amortization table is done here. And the journal for recognizing right of use assets is done here. And this is where we did our depreciation computation. That is the value of the right of use asset spread over 5 years divided by 5. We have it here, and we have the question here. So let's move on to our other things that we need to do. So this was the question we treated yesterday. We are going to move further by treating more questions this morning. We have been able to lay the foundation for this course yesterday, and what we shall be doing today is to ensure that we treat more examples to further enhance our understanding on these lease arrangements that exist between the lessee, the lessor, and the lessee. So this example is talking about Ifrs Limited. So Ifrs Limited acquired the use of a piece of machinery from PC PLC on 1st January 2004 under a lease contract. The lease contract requires 4 equal payments of these amounts. So let me put it in naira. 4 equal payments. You can see 4 equal payments of these amounts, 75,000 at the end of each financial year. The interest implicit in the lease is 10% per annum. The interest implicit in the lease is 10% per annum. It is estimated that the equipment will be economically productive for 5 years. The life of the asset is 5 years. The reporting date of Ifrs Limited is 31st December. There is an opportunity to extend the lease term at conditions favorable to Ifrs Limited. Required: determine the present value. You can see, determine the present value of the leased asset. That's the first requirement. And the second requirement says we should show the financial statement extract of Ifrs Limited over the relevant period of 4 years. So I'll be taking this question to our worksheet now, where we are going to be working on it, and I need you to pay attention. If you look at the difference between this question and the one we treated yesterday, you will observe that in the one we treated yesterday, which I just concluded now, they gave us the present value of the lease payment. But in this second question, they are asking us to determine the present value of the leased assets. They made it easier yesterday, but this one is more complicated. We are the one to determine the present value of the lease as the first requirement before we go ahead to show the financial statement extract. So I'm going to copy this question. I'll take it to the worksheet where we are going to be working on it now. Just 1 minute. Trying to make it. I will show you the Excel sheet. I know you can't see it from your hand, but you will see it now. Trying to put the question where it should be. So I'll share the worksheet with you now. So this is where I want us to solve this problem. This is where I want us to solve this problem. You can see the worksheet now. So let me. So you can see Ifrs Limited. That's the question we want to treat now. So whenever we have this kind of challenge, there is what we call annuity. Those of us taking SFM must have heard about that. Annuity and annuity factor. Annuity and annuity factor. So let me show the question. This amount payable every year is a constant cash flow. The 75,000 naira is a constant cash flow and therefore is an annuity. And it's going to be paid over 4 years. Over 4 years. It's going to be paid over 4 years. We need to understand at the end of every 4 years, according to the question, the amount will be paid. I want to highlight the portion where they said it is for 4 years at the end of each financial year. Okay, 4 equal. I'm trying to highlight the areas I want us to pay attention to. Machinery. These 4 equal payments. Yes, that's the place I'm trying to look for. 4 equal payments. You can see I just highlighted it here. 4 equal payments. That is what the lease term says it must be done. The lease term says there is 4 equal payment. 4 equal payment of 75,000 naira every year. That's what this company must pay as a lease arrangement. So to determine the present value, we will have to discount this 75,000 using what we call the annuity factor. The annuity factor. Annuity is a constant cash flow that is made over a period of time. So annuity factor, let me have the solution here. I want to do the solutions here. Solution. So we have the solution here. We have the solution here. And so the first thing is to determine, which is question A, is to determine the present value. So the explanation is to determine the present value. To determine the present value of the lease payment, we must discount the annual payments using the annuity factor. Using the annuity factor. So let me put that here. Let me wrap it here so that you can take everything that I've said to stay in that place. We must discount using the annuity factor. So annuity factor formula. Annuity factor formula. annuity factor formula. The formula for annuity factor is the present value, I write it as PV, present value equals to, then I open a bracket, 1 minus, I open another bracket, 1 plus R, plus R, then I close the bracket, raised to power minus n, then I close the bracket, raised to power minus n, then I close the bracket. This is what we call the annuity factor. The annuity factor. You see, 1 minus 1 plus R. I think I have two pluses here. 1 minus 1 plus R. You can see, raised to power n, raised to power minus n. This sign you are seeing here, let me bolding it so that you can see very well. This is the formula for annuity factor. This sign you are seeing here is how Z writes its own raised to power. This means that this 1 plus R is raised to power minus n, all divided by R. So this is what? Everything here divided by R. That's how to complete the formula. 1 minus, open a bracket, 1 plus R raised to power minus n, all divided by R. That is the annuity factor. So what we are going to be doing is to multiply the 75,000 naira annual payment by the annuity factor, and that is what we are required to do by saying we should determine the present value of the lease payment. So the annual lease payment put it in short. Annual lease payment equals to how much they gave us in the question, 75,000 naira. That's what the lessee pays every year. So therefore, the present value of the lease payment, which is PV of lease payment, will now be what? PV equals to, then we will multiply the 75,000 naira, 75,000 times, then we annuity factor, then open the bracket, 1 minus, open another bracket, our R, they have given us our R in the question, interest rate implicit in the lease. You can see it's what? It's 10%. Let me try to highlight it too. They gave us that to be 10%. I'm trying to look for where it is so I can highlight it for you to see very well. 10% per annum. That is interest rate implicit in the lease. You can see it here, 10% per annum. So that represents our R, and our N is the number of years the payment must be made, which is 4. So let me just put the figures here. R equals to 10% and N equals to 4, so that we have those information there to put into our formula of annuity factor. So I continue what I'm writing here. 1 minus, so 1 plus R will now be what? 0.1. 1 plus 0.1 will be 1.1. 1.1. I close the bracket and I say raised to power minus 4. I close the bracket and I say all divided by R, which is 0.1. This is the formula that will give us the present value of the annuity factor. Let me try to, of the lease payment, let me try to bolden it so you can see what I have done. You can also put it on pen at your end so you can compute along with me. So therefore, the PV will now be equals to, so PV, which is the present value of the lease payment, the present value of the lease payment will now be what? The formula, I want to put the solution here now, and I will do it here. You can also do it at your end. We have 75,000 times, then I open the bracket, 1 minus, I open another bracket, 1.1. I close the bracket, and I say raised to power minus 4. I close the bracket, and I say all divided by 0.1. That's exactly what we are to do, and I'll close the bracket as well. So, okay, I think the formula is too much. It's not. Okay, let me confirm if this figure is correct. Please confirm this solution at your end if it is correct. I want to try it on my calculator to be sure that the information I put into Excel is what it has returned back to me. So please, everybody, use your calculator, calculate what is on the screen. Let's see if the solution, if what you have is correct. I'm doing it at my end there. So 1 minus 1.1 raised to power minus 4 divided by 0.1, and this times 75,000. So we have 237,739, correct, 9.1. So this figure is correct. So this figure is correct. I can round it up to the nearest whole number, and I can see what we have here is correct. So this is the solution to what they asked us to do. So present value PV, let me do PV of lease payment is what we arrive at here. The PV of lease payment is what? Equals to this amount. Equals to this amount. Equals to this figure. That's the present value of the lease payment. We have been able to answer question A based on the information they gave us. I hope you have seen what I have done at my end here, which you can also try at your end here. This is the present value of the lease payment, which we are asked to calculate using annuity factor at the rate of 10% for 4 years. For 4 years, annuity factor at the rate of 10% for 4 years. That's what we did. Our R is 10%, our N is 4, and therefore the information here is put into this formula, and then we arrive at this amount. So we go to B part of the question now. B part of the question. If you have question, please, you can also drop it. You can always drop your question in the chat box. I'm checking it from time to time to see if there's any issue I need to respond to, which I have to attend to immediately. So please drop it in the chat box if you have anything to tell me. So I go to question part B of the question. Let's see what does the part B say. So we should show the financial statement extract of Pickers Limited over the relevant year period. So now that we have determined the lease, the present value of the lease asset, what are we supposed to do? We need to also determine the value of the right of use assets. The present value is the liability that must be paid, and if you look at this information, there is no other information telling us what else we need to add. Don't forget the formula. Let me share with you again the formula for computing the leased asset, the value of the leased asset. Don't forget the formula. It was part of what we treated yesterday. Look at this is the formula for calculating the value of the leased asset. First item there is what? The present value of the lease payment. That's the first item there, which is what we just computed now. If there is any advance payment or initial deposit made by the lessee, it will be added to it. If there is any direct cost incurred by the lessee, it will be added to it. And if there is any incentive given to the lessee, it will be deducted from it. And then we are going to be adding the present value of future dismantling cost. If there is any, we will add it, and whatever we get is what the value of the right of use asset. If you look at this table now, the only information we have in the question is the present value of lease payment. We don't have information relating to all others. So therefore, the value of the right of use asset is going to be the amount of this present value that we computed alone. That's going to be what we are going to be having as our the value of right of use assets. So there's no additional computation required. We just go straight to the journals for recognizing assets. So we're going to be saying the recognition. The first thing we need to do here, let me say Roman figure 1. The first thing we need to do here, Roman figure 1, is what? Recognition of the right of use asset. Recognition of the right of use assets. That's the first thing. And the double entry for recognizing that, debit, credit, is that we debit the right of use asset. Right of use asset is debited. Right of use asset is debited with how much? The only value we have. If there are more, we are going to be adding it to this liability. And then the lease liability is credited. Credit lease liability. We credit the lease liability with the same amount. Since there is no other information we have that will tell us that the figure is more than this, we will still be treating examples that will give us additional information. So this is just what being the recognition of right of use asset. That's the description of this journal. Being the recognition of the right of use asset. The right of use asset. In the recognition of the right of use asset. That's what we are going to be having. There. So that's the journal here. You can see that's the description to this first journal that we passed. That's that. After doing that, the next thing for us to do is to calculate the depreciation on the right of use asset. So let me do that. Roman figure 2. What we are doing in this now is what? Calculation of annual depreciation. Depreciation. That's the next task that we are going to be performing now. And don't forget, this is the value of the asset which was debited, and the question tells us that the asset has how many users. It is estimated that the equipment will be economically productive for 5 years. So we are going to be depreciating it on a straight line basis over 5 years. So annual depreciation, annual depreciation, and the annual depreciation is going to be what? The value of the right of use assets divided by 5, which is 5 years. That's the formula for annual depreciation. The value of the right of use asset divided by 5. And what is that going to give us? This divided by this will give us, this is the annual depreciation. So this is going to be our annual depreciation, 47,548. That is what we determine in that place. And next to that is that we must determine the third one is to have our amortization table, Roman figure 3. No, we are just showing our working before we now show the financial statement. This is very, very important. So amortization table. So for the amortization table, you remember how we did it yesterday. We are supposed to have like 3 columns. We are supposed to have like 4 columns for our amortization table. So the first trying to see. Okay, so for the amortization table, we have what we call opening balance. Remember what we did yesterday? I showed you how we do that. You can see it here. This amortization table. We have opening balance, we have the date, we have opening balance, interest, the payment, and the closing balance. So let me just copy the heading here, and then we'll take it to where we need it. So we are going to be having it here like this. Okay, let me check it again. I think the copy, and then I want to come and paste here. So we have it here. This is our amortization table. So if our amortization table is here this way, then we need to fill in the information. The date, it's going to be talking about the number of years. Don't forget this agreement was entered into on 1st January 20x4. So the financial years affected will be 20x4, 20x5, 20x6, 20x7, 4 years based on this information, 4 years. So the date is going to be, since this is opening balance, we are going to be having 1 January 20x. Okay, let me first put it. Okay, no, yes, the date. Let me just put the year so that it will agree with both opening and closing. So I'll say 20x for 20x4, then 20x5, 20x5, and then we move on like that to the 4 years, 20x7. These are the years that these assets will be in use under the lease arrangement. So the opening balance of the liability in 20x4 is the amount that we send to the liability account using the journal 23740. 23740. That is the opening 237740. That is the opening balance. And the interest rate here, okay, I copied this. Our own interest rate under this question is 10%. Interest rate implicit. Don't forget that's what we use in determining our R. And that's what they gave us in the question, 10% implicit interest. Interest implicit is 10% per annum. So that's what we're going to use for our amortization. So what we're going to be doing is what? We'll be multiplying this, the opening balance, by the interest rate, which is 10%, to determine the annual interest on the lease. Then the cash payment that is done every year, they already gave us in the question. It is 75,000. So we just put that one here, and it's paid evenly over the 4 years, 75,000. That is the value. That's the cash payment paid over the lease every year, 75,000, and that is exactly what is paid for the rest of the remaining 3 years. So that is constant. Don't forget that's the reason why we call it an annuity, constant cash flow, 75,000. So the closing balance will arrive. So this cash payment is going to be a negative because an outflow of cash. It's an outflow of cash. So it's going to be what? In negative. So let me just put them in jacket because it's the payment of cash that is done every year. It's going to be in negative. And then let me just copy this and paste over this too. So we have the cash payment there. So what we are going to be doing to arrive at closing balance is going to be what? Opening balance plus the interest element. Remember how we did it yesterday? Plus this. Then minus the cash payment, how much that we pay, then we determine the closing balance of the lease. We determine the closing balance of the lease. That's how we move. Opening balance plus the interest we computed plus this, then we arrive at this. So the closing balance for 20x4 is the opening balance for 20x5. So we just pick the figure there. We have it opening balance. 10% interest will be calculated on this by multiplying it by 10%. So this times 10% times 10%, and then we arrive at the interest rate. And the formula here is already in there. This plus this minus this must give us what will be here. So we just do that, and we have the figure there. And then the closing balance here is the opening balance for the following year. It's like that. Sorry, coming. Let me correct something here. So the closing balance here is the opening balance here, and interest rate will be computed on the opening balance to determine the interest for the period. That is what equals to this times 10%, 10%, and then we arrive at the interest, and the closing balance is the difference. Just like, this is the formula is already there. This plus this minus this must give us this, and then we'll come here to have what we call the opening balance for 20x7, which is this amount. And so we are computing interest on the 20x7 also by multiplying it with the interest rate. This times the 10%. And so we arrive at the interest, and this here must be what? This plus this minus this is what will give us this place. If there is any difference, because it's supposed to be 0, yes, this is accurate. The balance is 0 at the end of the life of the lease. That is, the lease is what? Is already nailed at the end of its life. So it is 0. It is 0. That is what we have here. So you can see how the amortization table is done. So from this amortization table, we have the amount of interest expense that must go to profit or loss, in addition to together with the depreciation charges on the lease every year. Those are the items that will affect the statement of profit or loss. Why these closing balances will go towards both current and non-current liability, and the asset at cost is 237,740 less accumulated depreciation and every year. That's what we are taking now. So first, let's do our statement of profit or loss. Statement of profit or loss. Statement of profits or loss. Statement of profit or loss. So when we have statement of profit or loss, the information we are taking there is what we need to know, which is what we already explained to us earlier. So I'm going to have the years put in this place. So 20x4, 20x4, 20x5, 20x6, and 20x7. That is it. That is what we have here. And then the first item we are taking to this financial statement is what? Under operating expenses. Don't forget, under operating expenses. Under operating expenses, we are going to be having what? Depreciation. That is annual depreciation. Depreciation. And that is how much we have computed that here. That's going to be the same over the years. Of course, it has to be in jackets. Annual depreciation has to be in jacket. And so we have it evenly spread. Okay, sorry. Let me just copy it and then paste it over this place. Okay. So we have annual depreciation here. Annual depreciation here. That is it. Annual depreciation. The next thing will be what? The finance cost, that is lease interest. Or we can call it finance cost. Under finance cost, we can call it interest on lease. Interest on lease. Interest on lease, which is how much we have here for each year. You can see it is clearly stated here how much we have here. So for 20x4, the interest is 23774. It's going to be negative also because we are taking it as an expense to the statement of profit or loss. And for this 20x5, it's going to be what we have here. Sorry, let me put the negative sign there also. And for 20x6, it's going to be what we have calculated it already. That's the purpose of doing this amortization table. You know where to get your figure from. And for 20x7, we have the interest already. So these are the information that will affect the statement of profit or loss as far as this transaction is concerned. So the next one will be to do the statement of financial position. Statement of financial position. So we come here. Let me put this one here this way. So statement of financial position. Let me do that one here. Statement of financial position. So for the statement of financial position, we have the 4 years also recorded, 4 years also here. So the first thing is what to calculate for the non-current asset, under non-current asset. Under non-current assets, we are going to be having the right of use asset, which is what we have up here. The right of use assets, that's its name for lease. We call it right of use asset, and the cost is going to be what we are going to be having constantly. The amount it has at cost is what we are going to be having constantly over the life of the asset. Don't forget, we are using historical cost. It's going to be constant, as the historical cost will be constant. And when that is done, we now need to do what? Accumulated depreciation. Accumulated depreciation. For accumulated depreciation, we know what it is each year. Depreciation for each year will be accumulated over the life. This is depreciation for years 20 years for. When it gets to this place, it's going to be what? This depreciation plus the other one, which we must have there, and then that's how it will increase. Accumulated depreciation will increase. It's going to be what? This plus this plus this. That's the accumulated depreciation. And here it's going to be what? This plus this plus this plus this. Accumulated depreciation. And so we can net it off to determine the carrying amount. This is the carrying amount for each year. You can see that's the value, the carrying amount of the assets under non-current asset. This is how this will be treated. Then we now go to current liabilities and non-current liabilities. Current liabilities. We are going to be having what? Lease liability there. Lease liability. Lease liability. Then under non-current liability also we are going to be having lease liability. Non-current liabilities. We are also going to be having what? The lease liability. Let me put in this. Then we're going to be having the same thing, lease liability, the same description, lease liability. So for the current liability in 20X4, it is the amount payable in 1 year time. This is the actual amount payable, but part of it is interest. So we just net the interest out of it. Is the amount that will be paid in 1 year time. After, at the end of 20X4, this is outstanding as amount that will be paid in 1 year time. So to calculate the liability, current liability, is going to be the amount that we are paid, the amount of cash we must give out, minus the element of it that must be interest, which is this. And so we arrive at the current liability at the end of year 1. Current liability at the end of year 1. Then the non-current liability at the end of first year, which is 20X4, is going to be the amount that will be outstanding at the end of 20X5. That's a non-current liability. The addition of the two must give us the closing balance of the current liability at the end of year 1. If we have the two together, we must have this same thing that we have. So let me just do this place. The table is there. That's why I'm going to be putting my total. You can see 1851, 186514. That is it, 186514. At the end of year 20X4, the closing balance of our liability is 186514, and it is split to both current and non-current elements. We have the same thing. Also for 20X5, the amount payable in 1 year time, the amount payable in 1 year time is 75,000. That will be paid in 20X minus the interest element of it. And then that's where we arrive at the current liability at the end of 20X5. 20x5, sorry, and the non-current liability will be the amount that will be outstanding at the end of that 20x, that is amount beyond 20x, beyond 1 year time, and we have it that way. So when we total this one also, it's going to give us the closing balance of liability at the end of 20x5, which is what we have there, 130,165, 130,165. You can see how I'm moving and I'm doing my computation. That's how you are going to be splitting it. So we come here also, we have the amount payable, in 1 year time. The amount payable in 1 year time is 75,000, which is the last year, and then minus the interest elements in that 75,000, and we arrive at what we call the current liability at the end of 20x6, and the non-current liability is going to be 0 because there is no amount payable beyond 1 year, because everything that we paid is going to be paid in 1 year time. So we are going to have 0 current liability, 0. This one is going to be 0. Non-current liability will be 0, and so that's how that will be done. And so by the end of the year, by the end of the year, there is no liability outstanding. It would have been paid. So current liability will be 0, non-current liability will be 0, and that's how your presentation will be done in the financial statement. I hope you understand what I have done. We have been able to satisfy the requirement of this question, and then we can move on to the next task. You can see how this is done, how this is achieved. Current liability. So under the asset, we have done the issues that has to do with assets here, and the ones that has to do with liability, we have also been able to do it here. So that is it. And so our balance sheet is complete now. We can move on to the next question. I hope you don't have any question in respect of this statement of profit or loss, statement of financial position. You can see how we started. First, determining the lease payment, which is the present value of the actual constant annual payment using the annuity factor, and then we pass the journal to recognize the lease and then the liability, and then we move on to do our depreciation charges, which is every year, and then here we have what we call the amortization table. And so our statement of profit or loss, we only carry the depreciation charges and the interest on lease, and then our statement of financial position will deal with the non-current asset, the right of use asset, less accumulated depreciation, and we have this balance as the carrying amount of the asset. And then we have our lease liabilities split to both current and non-current elements, and we have it here. That is the financial statement extract that we are required in the question to work on. So I want to move on to the next example now. Let's move on to the next example. So we just finished treating this example. This was the one we did yesterday. We just completed treating this one. That's another example on ABC PLC. Now, there is a difference between lease payment in advance and lease payment in arrears. The two examples we have treated have dealt with lease payments in arrears. If you look at this first example that I treated yesterday, they said the terms of the lease requires XYZ Limited to make 4 annual payments of 2 million each payable at 31st December, end of the year. This is lease payment in arrears. And this one we just treated now says that the lease contract requires 4 equal payments of this amount at the end of each financial year. So it is lease payment in arrears. But the example we are having now is talking about lease payment in advance. You need to see how that is done. It's different from the way we calculate lease payments in arrears. Lease payment in advance is the lease payment that is done at the beginning of the year. That is 1st January every year. That's when the payment is made. There is a way to compute that. There is a difference in the computation of that. So you have seen everything that So I'll take this one now to our worksheet where we are going to be dealing with it as appropriate. We are going to be dealing with it as appropriate. I hope everybody is following and nobody has question yet. Checking the chat box in case anybody is saying anything. Okay, so let me just move this. Let me move this question to our worksheet where we shall be dealing with it now. So, take it to our worksheet. Let me take it to our worksheet. So I want to copy the question here, and then we move on. This is a question coming. I'll draw the question there now so that everybody can see. So we'll treat this example here as our example 2 this morning. So let me put the question here first. So this is a question here. Let me try to increase the font of the question so that everybody can see, be able to see it on your phone. That's it. So this is the question we want to treat now. I believe you can see it at your end there. This is the question we want to treat now. This is different from the ones we have treated in the past because this is talking about the payment of the lease payment in advance. The yearly payment of 2.5 million is done in advance, commencing on 1st January 20X3. You can see, I just want to highlight the important aspect of this question, which made it different from the ones we have treated before. Now, first, the procedures are still the same. So I'll put the solution here. Let me have the solution here. The solution. So we read the question again. Let's read the question together again to know the content. ABC PLC acquired a machine for the next 5 years by entering into a lease contract on 1st January 20X3. The reporting date of ABC PLC is 31st December. Under the terms of the lease contract, ABC PLC is to pay 5 installments of 2.5 million yearly in advance, commencing on 1st January 20X3. The rate of interest in the lease is 12.6%. The machine has a useful economic life of 5 years. There is an opportunity to extend the lease term under favorable condition to ABC PLC. Required, show the financial statement extract of ABC PLC over the relevant lease period. You can see. So the first task here, the first example we did, they were kind enough to tell us to first find the present value of the lease asset. But they didn't say anything like that here because they assume that we are maturing as we are progressing on the course. The first task when you are given a question on lease, IFRS 16, is to determine the present value of the lease payment. Don't forget, this is an installment that must be paid yearly. So, and the payment will last for how many years? It's 5 years lease. You can see 5 years, and the payment is 5 installment. So, first task is the first thing we must do. Roman figure 1 is to what? Is to find Roman figure 1 is to what? Calculate the present value of the lease payment. So I'll say computation of the present value of the lease payment. That's the first task that we must do. And we have an idea on how to do that already because we treated it in the last example. The formula to do that is what? PV, that is the present value, equals to, now the amount, we are including the amount there, 2.5 million, 2500. So present value will be equals to 2.5 million times, then we open a bracket, 1 minus, open another bracket, 1, what's our R? 12.6%. That will be what? 0.126. Don't forget. 0.126 plus 1 is going to be what? 1.126. 12.6% is 0.126. 0.126. So I think we are into bracket 1.126. Close the bracket. Raised to power minus how many years? N is what? 5 in this case. Then we close the bracket, divided by 0.126. That's it. That's the formula. Let me bold in it so that you can see clearly what I have written. This is it. This is it. So this, let me put in this one as well. The task we have is to what? Compute the lease, the computation of the present value of the lease payment. And this is going to be the information we need to do the computation. I hope you get it. Our N, let me put it here so that you know how we arrive at the figure. Our R equals to 12.6%, which is given us in the question. And then our N equals to 5, which is given us in the question. Let me put in that as well so that we can see clearly. That's how we enter the information inside this place. So PV will now be what? The present value of the lease liability. I'll put the solution here for 6. So I'll just put in the formula 2.5 million, that is 2500000 times, then I open the bracket, 1 minus, open another bracket, 1.126, 126, I close the bracket and I say raised to power minus 5, I close the bracket and I say all divided by 0.126 and I calculate the figure. So here we have the present value of the lease payment, the present value of the lease payment. Please, everything I'm doing at my end here, don't forget I'm using formula in Excel. I will advise that you also test them on your calculator to be sure that we are arriving at the same thing, to be sure we are arriving at the same thing and that the computations I'm doing do not have any error. Please, anytime you come to a class, we are doing calculation, make sure you have your calculator with you. In case there's any mistake on my hand, you can quickly draw my attention to it. So that's the first task. Every time you are faced with a question on lease, first thing is to calculate the present value of the lease payment, and you are going to be discounting the annual payment by the annuity factor. And so we arrive at it, 8,879,580. So the second task, Roman figure 2, is to determine the value of the right of use assets. Calculate the value of the right of use asset. Calculate the value of the right of use asset. That's the next task that we must do now. How do we do that? We have a formula for doing that, but we need to go and check the formula to see if there is any information in this question that will point us to other information we must add in determining the value of the right of use asset. So let me quickly show us the formula we have already. We have seen the example today. I would just want us to look at it together again. This is the formula for calculating the value of the right of use asset. This is the formula. So the first item is what the present value of the lease payment, which is what we have just computed. Add any advance or initial deposit. Add any advance payment or initial deposit. Now, what we did in determining the value of the right of use asset is to look at the 5 years period that these will be done. Now there's an advance payment. Okay, I'm coming. We discounted it. Okay. Now there is a correction. Sorry. That this I need to draw your attention to this part. Now, on the first to calculate first, let's get this now. To calculate the present value of the lease payment is going to be what? The present value of any outstanding payment as at the date we are determining the lease payment. Now, I made a mistake in this question now because before I correct it, I want you to get it. Now, this is a lease payment in advance. It means that as at 1st January 2023, the first installment of 2.5 million has been paid because it said what? Commencing on January 1, 2023. Therefore, when we are computing our liability on that date, that first installment will not be put into consideration. The only things that will be considered will be the 4 installments remaining. Don't forget that this installment is going to be 5, and the first one is already paid on this date. So instead of our end becoming 5, our end will be 4 in determining the liability, because what the first installment has been paid. So that is the only error I want to correct in this question. Our end will be 4 because it's a payment in advance. The installment that remains unpaid as at this date will be the 4 installments remaining. Please, do you get it? It's going to be the 4 installments remaining. The first installment is already paid. So I'll just change the information I'll change in our formula is the 5 years, that must be 4. And so we are going to be having this value as the present value of the lease payment. So in calculating our right of use asset, the informations that are relevant are the following. We have what? The present value of the lease payment. Let me bold in this. The present value of the lease payment, which is how much, is what we have here. So let me put the information here. Present value of lease payment. Present value of lease payment. We already have that information here. So I just put it there. Okay. Let me space is much. The present value of lease payment, we already have the information here. I just put it there. Then if you look at it in the I'm coming. Have I shared? Oh, sorry. I wasn't showing you the Excel sheet. Sorry. Let me do where I was doing the correction from. This was where I was doing the correction from. So instead of n being 5, n must be 4. And so I'll change the formula here. Our n is 4 minus 4. So we arrive at this as the present value of the lease payment. So other information that will be added is what we have in the table. What we have in the table here. You can see the advance payment that is made. Add advance payment or initial deposit. So the advance payment that is made, which is going to be the additional information we are going to be adding here, is the 2.5 million that is paid in advance. 2.5 million paid in advance. So add advance payment. Add advance payment. And how much is our advance payment? 2.5 million. The first one paid in advance. So in determining the value of our right of use asset now, we are going to include the advance payments. Let me bold in this as well so that everything can be boldly seen on your phone, because I know many of us are using our phone. So the value of the right of use asset, therefore, is the addition of these two, which is what we have here. The addition of these two, which is what we have here. That's the value of the right of use asset. The present value of the lease payment, that is the outstanding payment as at that date, which is 4 installments remaining, is this. plus the advance payment we have made already on the lease, which is what we have here. So this becomes the value of the right of use asset, and the double entry is debit, credit. So double entry is what? Debit the right of use asset, right of use assets, and credit the lease liability. Lease. Debit the right of use asset, and then credit the lease liability. Yes, lease liability, and then credit bank with the amount that is paid outright. Credit bank. So right of use asset will take how much? This amount. The lease liability is credited with how much? This computation we did, and our bank will be credited with the amount of the initial deposit we made. And so we have our journal balanced. Our journal is balanced. You can see our journal is balanced based on that computation. And the description reward being the initial recognition of the lease, being the initial recognition of the lease, being the initial recognition of the lease. So that is going to be the description in our journal. That's going to be the description in our journal. Okay, let me just extend that here. Let me extend that for it to be clearly seen by all. So that's going to be a description of our journal that we have just computed. So let me do this as well. I'm just trying to ensure that we have okay. Let me do this. So we have this. I want to capture. This is how it is done in practice. Your journal description should not extend beyond your description, the calculation. So this is how we do it in practice. So being the initial recognition of the lease, you can see everything we have done here, and now I've done it. I use T with me. Nobody is saying anything since. Doesn't mean you are following, or am I on my own? Are you there with me? I can see Mr. Blaine and Mr. David in the house. Juliet, maybe you went off. Maybe you went to sleep. You watch the video later. Okay, no problem. So I hope you are still with me. Can you hear me clearly? You can use the chat. Okay, thank you very much. Okay, thank you very much. So that's on this. So after we have done this, determining the value of right of use asset, which is what we have done here, which is the second thing we did. The first thing we did is to compute the present value of lease payment. We did it here. Determine the right of use asset and passing the relevant journal. We have done it here. The third task will be what? To compute depreciation, annual depreciation, Roman figure 3. Annual depreciation. So calculation of annual depreciation. Calculation of annual depreciation. Calculation of annual depreciation. The question told us that the asset will be economically useful for how long? The machine has a useful economical life of 5 years. So the right of use asset will be depreciated over 5 years. That is, this amount will be depreciated over 5 years. So annual depreciation will be what? Annual depreciation will be this amount here, which is the value of the right of use asset, divided by 5. The 5 years that the asset will be used. You can see that's how to calculate our annual depreciation. And how much is that going to be? This divided by 5 will give us this amount, 199,968. 199,968. That is the value of our depreciation. That's our depreciation value, annual depreciation. So the fourth thing to do now is what? to do our amortization table. My figure 4, amortization table. That's what we must do now. And we have seen how that is done. You can see it's something we have there. Let me just copy the heading, the amortization table. This is how it is being done. How the amortization table is presented. This is how it has to be presented. So, So amortization table is there, and the interest rate we are using in this case is what? Is 12.6%. So I'm going to edit this one. It's going to be 12.6%. 12.6. That is the percentage of the interest rate. So how many years are we working on? We are working on from 20x3 to what? To the end of the life, 5 years to death. So we'll do 20x3, 20x4, 20x5, 20x6, 20x7. It's 5 years. It's 5 years. The lease payment is 5 years. So that is it. It's 5 years. So now that we have the years put, what is the opening balance of the lease liability? The opening balance, okay, now another thing to note when lease payment is made in advance. Instead of cash payment coming behind interest charges, it will come before interest charges, because payment is made before interest is calculated. Payment that is made after interest is calculated is payment in arrears. That one is made at the end of the year. But payment that is made in advance is made before the interest rate is calculated. The impact of computation of interest is that it is calculated at the end of the year what the annual interest on the liability, outstanding liability is. But because payment is made earlier, we are going to switch position here. The interest payment comes after the interest component comes after the payment is made. So payment is made at the beginning of the year. Interest will be computed on the outstanding balance at the beginning, and then the cash is the balance, closing balance is stated there. I hope you understand what I'm talking about, because this is what lease payment in advance. Lease payment in advance. So opening balance is the value of the right of use asset. The value of the right of use asset is the value at the beginning, and then the initial cash that is paid is 2.5 million. It will be there as a negative figure because an outflow of cash. Then we calculate interest. Okay, I need to now let me restate the balance so that you know what we are calculating interest on. So we now have our opening balance here. So this is not going to be the opening balance. Okay, there must be something I call this value of the right of use asset. This is going to be what? Opening balance restated. So let me call it opening balance restated. After the payment is made, we will have to restate our opening balance. Opening balance restated. So let me do that. Let me put the description there. Opening balance restated. Coming. I want to edit what I have in there. So I want to restate opening balance restated. Opening balance restated. Why am I restating the opening balance? It's because some amount has been paid. Some amount has been paid. Some amount has been paid after we opened with what we have restated. Some amount has been paid. So we have to restate it by what? Deducting the amount that is paid from what is outstanding at the beginning. So this becomes our lease liability. Don't forget, it's the same thing that we have here, that we now have as our outstanding liability at the beginning. So interest will now be computed on this. That is, it's going to be what? This times 12.6% times 12.6%. That's the interest. And then the closing balance will be the addition of these two. see, that's why it's different. You can see why, what's it called? Payment in advance is different. How payment in advance is different from what we are computing. And so this becomes the balance here, the opening balance, and then the payment is made again. A payment is made again at the beginning. It's a payment in advance. So we are going to be having our opening balance restated again, and we are going to have it like this. That is this minus this. So interest will be charged on this. That is, this is going to be what? The interest will be what? This times 12.6% times 12.6%. We have our interest. And the closing balance is going to be the addition of the two, which is what we did here. In Excel, I can just drag it like this. I have our closing balance presented. You can see. Then we have here what we call the opening. And the opening balance will be restated by when we pay this payment is made in advance. And so we are going to be having this like this. That is this minus this. Interest will be charged on this outstanding. That is this times 12.6%. And so we have it that way. And so we are going to be having our closing balance as what? As this plus this, the interest plus the outstanding liability. And here we have our opening balance. This amount comes here as the opening balance. Then this amount, another amount is paid, which is 2.5 million, paid every year. And we are going to be restating our opening balance by deducting this from this. And interest will be calculated on this. So interest is going to be this times 12.6% times 12.6%. And so we have our interest. And so the closing balance is going to be the addition of this to this plus this. So we have our opening balance restated, and then we have this as the opening balance. We have our opening balance, the payment is made, therefore there is no computation of interest, because by the time we say this minus this, what we're going to be having is 0. No interest is considered payable in year 5. The liability is only for 4 years, because we paid the first one at first. So interest will only accrue when we have outstanding liability. You can see what we paid equals to what remains. So that's how this will be done. This is how payment in advance is done. That makes it different from payment in arrears. That makes it different from payment in arrears. So that's it. We have been able to sort this out, and then we are good to go. You can see this is how the amortization table of payment in advance will look like. The payment comes before the interest is charged. The payment comes before the interest is charged. The payment comes before the interest is charged. And so we have the table like that. So we have our amortization table here. So after the amortization table, what next is to prepare our financial statement extract. Statement of profit or loss. Statement of profit or loss. Statement of profit or loss. When we do that one, you know the information that will go there. Only the depreciation charges and the interest on the liability. So I'm going to have the years put here. That is 20x from 20x3, 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 20x4, 20x5, 20x6, 20x7, 5 years. That's it. This spread over 5 years. So the first thing under operating expenses, operating costs, operating costs or expense, whatever we call it, we have depreciation, and then we have what we call lease interest on lease, interest on lease. So depreciation, annual depreciation is constant. We know we have calculated that in our working tool. So our depreciation is what? We come here, we pick it, which is what we did in working 3. These are our depreciation, negative figure. It has to be negative figure. And so we have our depreciation is the same thing over the years. Annual depreciation for 5 years is the same thing over the years. So we have our depreciation charges presented that way. Then the next thing is to compare, bring in our lease interest, the interest on lease that we are supposed to pay. So in 20x3, the interest on lease is this amount. In 20x3, this is the amount of interest on lease. So I just take that there. And in 20x4, we have these as the interest. In 20x5, we have these as the interest. In 20x6, we have these as the interest. And so we have our interest clearly brought into the financial statement. 20x7, there's no interest, so it's 0. For 20x7, no interest. That's how this will be presented. So the next one is statement of financial position. Statement of financial position. Statement of financial position. Statement of financial position. And so we have the years. You know the information that will be coming here. Information relating to the asset and liability is what will be coming here. So what we are going to be having first is the non-current assets. Current assets. And we are going to be having the right of use asset under it. Right of use asset. So at cost, the amount recognized as the value of the right of use asset, which we computed based on the information here, is this amount. So we're going to be having it here. This is the amount of the right of use asset at cost, and it's going to be constant over the life of the asset. It's going to be constant over the life of the asset. That is, we are using historical cost method. And so we have the figure is constant over the life of the asset. So accumulated depreciation is going to be the depreciation we charge every year. Depreciation we charge every year, which increases as the year goes by. That is this plus this here and here equals to this plus this plus this. Accumulated depreciation. So here equals this plus this plus this plus this accumulated depreciation, and here we have equals this plus this plus this plus this plus this accumulated depreciation. So we have the carrying amount of the asset, that is cost minus accumulated depreciation, and then we have that over the years of the asset. So the asset is 5 years, the lease is 5 years. At the end of this year, the asset has zero carrying amount. So the next thing is to calculate the current liabilities and non-current liabilities. Current liabilities and non-current liabilities. Non-current liabilities. So we are going to be having these liabilities under each of them. This liability. So we have these liabilities under each of them like that. So current liabilities, non-current liabilities. So this liability that falls under current liability in 20x3 is the amount payable in 1 year time. Now, this is different from the payments in arrears that we did previously. You remember, in payment in arrears, we are removing the interest element. But when we did our amortization table here, interest is not considered before we considered how much that is payable. So this amount does not have interest element. Interest element only accumulates on our non-current liability. So our current liability is going to be the exact amount payable in a year time. So current liability here is going to be what? How much that is payable in 20x4, which is how much this amount. Current liability here is how much that is payable. You can see the same thing is what we are going to be having payable in 20x5, and here current liability is how much that is payable in 20x6. Current liability here is how much that is payable in 20x7, and by the 20x6 no current liability again, because no amount is payable beyond 1 year anymore. And so we are going to be having our non-current liability is going to be the amount payable at the end of the year 20x3. How much was the amount payable at the end of 20x3? This is the amount. You can see. Yes. 20x3. Sorry, that is not the amount. This is the amount. It's going to be this amount payable. The non-current liability is the amount payable beyond 1 year, which is what? The amount payable beyond 1 year is this amount that is here. That is the one that will be the end of 20x4, which is this one. So here the same thing. It is this one. And here we're going to have this one. This last one. That's it. So there's no non-current liability at the end of the year 20x6, no current liability at the end of 20x7, no non-current liability, and there too no current liability at the end of the year. So these are what we have in the financial statement, and just like we normally do, we can then total our current and non-current liability to know the total value of the liability that we are supposed to pay. This is the amount payable in a year time. So if you go now, the difference why this is not agreeing with the closing balances, the difference is that interest now comes on this. So if you had this, for instance, let's test it here. If you had this amount payable plus the interest on it, which is this, that year, we are going to be having, let me check again. This amount payable, this is the amount payable in 1 year, current liability, and I said this is a non-current liability closing balance. So how that is discharged, I want to prove how that is discharged over the 5 years. How that is discharged over the 5 years. Current liability, non-current liability. So what make up this? These amounts payable in 1 year time, and this amount beyond 1 year time. And by the end of this year, the current liability is the amount we pay at the beginning of 2007. This is how we discharge our current liabilities and non-current liabilities. The figures don't agree with the closing balances here because of when we compute our so if this is added to this, of course, we are supposed to have the figure. If this is added to this is added to this. But because this is paid before the interest is calculated, we are having different figures here. But this is how it will be presented. The amount payable in 1 year time is the current liability. No separation of interest element, because you will know that no interest is calculated before we deducted it. You see, No interest. Interest is now calculated after we have deducted it. So there's no need to separate the interest element inside it, because this one does not contain interest element at all. It is deducted before interest is computed. So this is how the table is going to be. This is how our balance sheet is going to be like. Our balance sheet, that is statement of financial position, is going to be exactly like this. I hope we get all this discussion, or you have a question. I hope we get all the discussion and that we do it as right. We have had examples of payment in arrears and payment in advance. You can see the steps to treating items of lease. First, determine the present value of lease payment, which is going to be the liability over the lease term. Liability over the lease term. And then we calculate what? The next one is to calculate the right of use asset. The present value, this one has advance payment, is added to it. If there are other elements also that is contained in that computation that is in the question, you must add it in determining what is there. You pass the journal, debit the right of use asset, credit the liability with the amount outstanding, and credit bank with the amount of payment that is made on the first. Debit asset, credit bank. And so calculation of depreciation is done, and we have our amortization table done like this, and we have our profit and loss account prepared like this. Do we have any question? Time is not on our side. We still have more, but I will give it to us as an assignment. Please, I expect you to work on the assignment when I give it to you. It will help me to know if you have really understood what we have done or not. There's an example on unwinding cost here we have not treated on determining on the unwinding cost. That is, if there is going to be, you have to restore the site back and dismantle the site. There is the same procedure, the same way we did it under IS 16. It tells us that there's going to be a dismantling in the future. The cost of dismantling in the future, we will discount it to the present value. And every year, we'll be charging finance cost on it. That is what we have here that makes this one different. So I will test our knowledge by giving this to us as an assignment. I'm coming. Sorry, you are not seeing the screen. I'll test our knowledge by giving this to us as an assignment, and I want us to work on the assignment. And please get back to me. Then another thing, to help us, we have so much to do. While I focus on teaching, I will expect you to be tackling past questions on any standard that we have treated. IFRS 15, IAS 12, IAS 16. We have also treated the IAS 8, and this is IFRS 15, which I'm rounding up this morning, except there is a correction to the assignment if you do the assignment. That's the only reason why I will touch this standard again. We will need to move on to other standards. Don't forget, we still have to learn group account. We have to learn about ratio analysis, other things that come out in both FR and CR. And there are some standards that are outstanding for CR, which I will have to take only for the professional class. So we still have time, but we can't be counting on that. We need to be working hard so as for us to beat the time and have enough time to revise before the examination comes. So I want to put this I want to put this in the chat for us as an assignment, which I want us to do. I'll put it in the chat. You can see it there, and then I want us to treat the assignment as urgent, possible for us to get it done today. Let's do it. Let's do it and send it back to me in the chat group so that I'll be able to see it and assess if you have truly understood what we have done. So, coming. So I have the assignment here. It's in the chat box. You can see the assignment in the chat box. So please check it, work on it. Of course, there are things here, information here that is not in the example we have treated. But if you watch this video again and you look through the examples we have treated, you will find a guide on how to treat the assignment. So we are calling it a date this morning. If you have any question, you can ask now before we shut it down. If you have any question, you can ask now before we shut down this morning. Thank you very much.